I think the biggest issue we have here is that we can talk all we want about short-term and long-term management. If we don't educate the investing community about asking the right questions of companies, we're always going to be pushing water uphill. Teresa, I'll be honest with you. In the United States, 90% of the companies we talk to, the buy side, never ask us a question and stick with a discussion of strategy. They want to know, how's the quarter going to turn out? How's sometimes weekly sales? Why are your weekly sales this way? And how's the rest of the year going to turn out? If you go over to Europe, they ask you questions about the long term. And if you go to Asia, they ask you questions about the real long term. So I think we have to really think through, how do we want to think about duration? Is it quarter and 1 year? Is 1 year long term for the US and quarter short term? Is it 3 years, 5 years that's the appropriate long term? I don't know. We have to have that discussion.
The real issue I see, though, if a CEO, they have strategic assets. Indra does, Carlos does. They know what's going to make their company great. They know where they have to invest. The question is, how do they convince Teresa and the asset owners that they're investing in the right place? And at the same time, in the short term, they can go up or down based on volatility, based on analyst expectations or guidance or things like that. The problem is, I'm going to come back to what Carlos said and I said originally, there's no way to measure whether what they're telling us is exactly right, like there isn't quarterly earnings. And so you have to really explain your long-term strategy, and you have to come up with some way for agreement between asset owners and managers and corporates to measure that and compare it to quarterly earnings. Otherwise, there's only one thing to fall back on, and that's the short term.
But Mark, let me ask you a question.
Yeah.
Let's say that CEOs are willing to spend the time to educate investors on the strategy. You think investors, I'm just asking the question, Teresa, not an opinion, are they really able to understand what companies are saying? That's the first question.
I raised this morning in a discussion. I basically think there's a big disconnect between investors and value creators. So we extract value from the market. You create value and contribute it to the market. And I think that's a really fundamental a difference in view and expertise. And so I've been quite skeptical of the investment community's ability to really discern what is going to create value, what's going to create corporate value over time. And I think part of it is we're giving the wrong kind of education. The CFA Institute, it's all focused on pure financial metrics. I think there needs to be a lot more business education of analysts to understand that. So I kind of look at, if you think about engagement between investors and corporations, I think we're in very early days, and I think the whole engagement process and the people who are doing that has to change.
I think finance and accounting has trumped strategy excessively.
Totally.
The whole world is ratio-driven, comparison-driven, and accounting-driven, even though the accounting rules are not clear across companies.
We know they don't reflect value, long-term value.
And so what happens is they just look at the numbers and say, well, this person's G&A is 8 and yours is 10, therefore you've got 2 points to cut. Not thinking about 2 different models of the company, because you got to spend to get efficiency. Nobody thinks about the strategic consequences. They blindly look at the numbers, and a bunch of number crunchers put out a little spreadsheet, and that to them is strategy.
But some of the legal framework actually constrains what the pension funds and others do, because they have a fiduciary responsibility. And the question is how you interpret that. I think the way that it has been interpreted is wrong. So right now, as a fiduciary responsibility, it often means maximizing short-term value, because that's the only thing they can easily see. But there are other things that we know are going to happen. For instance, we know that climate change is going to happen. We know that there's going to be a carbon price, and that assets, companies that have large carbon assets, the value is going to go down. So I think there's a huge climate risk for anybody that's investing in a fossil fuel company. And so I think it's a violation of their fiduciary responsibility to focus on short-term returns if you buy a fossil stock and not think about the climate change. And the same thing, moving into electric was very important for you, because you would have been a fossil company if you hadn't done that. And now you're leading part of the way for electric cars. And so as we think about the future, I think that there are many areas where, if you look at what civil society does, if you look at where, the concerns that we as a community have, they are anticipating where the regulatory environment is going to be in the future. And to ignore that signal, I think, is a violation of fiduciary responsibility and poor investment.